Okay, so you want to own a car wash. Drive past one on a Saturday afternoon, and it looks like the most obvious business in the world. There's a line of cars wrapped around the lot, a machine doing all the work, two people standing near the exit with a towel, and a sign that says unlimited washes, $25 a month. You look at that and you think, this is basically a vending machine that cleans cars. What's not to love? Here's the thing. A car wash is not a car cleaning business. It is a subscription business that happens to have soap and conveyor belts in it. And once you understand that, everything about how it makes money and how it quietly loses it starts to click into place. This video is going to walk you through what it actually costs to get in the door, how the money really works once you're running, and the part that almost nobody talks about before they buy one, which involves water, drought, and a government decision that can quietly cap your entire market before you ever open. I've been digging into the real numbers behind this industry, and there's one thing I'm going to save for the end that genuinely changes how you should think about the whole model. So stay with me. Let's start with what it costs to get in, because the number is a lot bigger than most people assume. Opening a car wash in 2026 costs anywhere from $100,000 for a small self-serve operation to $5 million or more for a full-service express tunnel. And if you're thinking about the format that private equity has been pouring money into, the express exterior tunnel, the conveyor belt machine that pushes 60 to 100 cars through per hour, conveyor and tunnel equipment alone runs $1.40 to $2.1 million. And total project cost ranges from $3 to $7 million depending on land, tunnel length, and technology. That's before you've washed a single car. The dirty secret of car wash construction is that the site work and the permitting can equal the equipment cost, and almost nobody budgets for it correctly the first time out. You need a corner lot with serious traffic. Traffic count of 25,000 or more vehicles per day on the frontage road is the baseline. 40,000 or more is ideal for express tunnels. And building a new express tunnel costs 30 to 50% more than it did 5 years ago. So the window where this was a cheap entry is already closed. Now, once you're in, the operating model is genuinely impressive. Express tunnels are very high throughput, 60 to 100 cars per hour, and run on low labor, just 1 to 3 employees. The margins on a well-run site are real. A well-located express tunnel can gross $1.50 to $4 million annually with operating margins of 35 to 50%. That's the pitch that got private equity excited, and it's not wrong. The unit economics on a mature, well-located wash are legitimately good. The problem isn't the wash itself. The problems are everything around it. So let's talk about the subscription model, because this is where the business gets interesting and a little sneaky. The whole industry shifted over the last decade from selling individual washes to selling unlimited monthly memberships. The pitch to the customer is simple. Pay $25 a month, wash as many times as you want. Customers love it. Operators love it even more, but not for the reason you'd think. A typical express tunnel converts 30 to 50% of regular customers to monthly memberships, and those members wash 3 to 4 times per month on average. But here's the part that makes the whole model work. The average member washes about 2.6 times a month, and the marginal cost per wash is only around $1.50. That means a light user, someone who pays $25 and shows up twice, is dramatically more profitable per dollar than the unlimited branding implies. The unlimited pitch sells on the idea of heavy usage. The margin is actually built on people who forget they're subscribed. Sound familiar? It's the exact same math that runs every gym in America. And that's actually the first crack in the model, because here's what makes a subscription genuinely valuable: switching costs. Gym contracts are annoying to cancel. Software tools are painful to leave because your data is inside them. Streaming bundles bundle things together so you feel like you'd lose something by leaving. A car wash membership has almost none of that. If the only benefit is unlimited washes, canceling becomes a pretty easy decision. All a member has to weigh is whether getting their car washed a couple of times is worth one more recurring bill. The moment budgets tighten, that math tips fast. The subscription looks like a moat. Structurally, it's closer to a light touch habit that snaps when people start cutting expenses. That said, the recurring revenue is still real, and it's still why this business attracted so much capital. Operators transitioning from episodic ticket sales to membership-based models are turning unpredictable demand into steady cash flow. That part is true. The risk is in assuming the members will stay forever, because they don't have to. Now here's where the story gets more complicated. And I promised you something at the beginning that most people in this industry haven't fully processed yet. We're getting there. But first, let's talk about what happened when private equity showed up with a lot of money and a lot of debt. The last 5 years in car washing looked, from the outside, like a gold rush. Private equity firms figured out that a business with predictable subscription revenue, low labor, and high margins was exactly the kind of thing you could buy, roll up into a big chain, and sell at a premium multiple. Independent operators controlled about 67% of the car wash market in 2025, yet franchised and chain formats are expanding at nearly a 10% annual rate. So the consolidation play made sense on paper. The problem is what happens when you borrow a lot of money to buy a lot of car washes and then interest rates go up. Zips Car Wash, an aggressive leveraged consolidator, filed Chapter 11 in early 2025 carrying $653.9 million of funded debt, closing underperforming sites through the process. The washes worked fine. The debt structure didn't. And Driven Brands, having taken an $851 million goodwill impairment on its U.S. wash segment, exited entirely, selling its car wash unit for $385 million, a fraction of aggregate invested capital. This is an important lesson for anyone thinking about buying into this space. The 2025 collapse of a major chain wasn't a car wash problem. It was an interest rate problem wearing a car wash costume. Aggressive debt-funded expansion into increasingly saturated markets, combined with interest expense climbing as rates rose until a maturing term loan forced a restructuring that wiped out unsecured creditors and equity. The wash itself worked fine. The leverage structure underneath it didn't. The business model didn't fail. The financing model did. And speaking of financing models, there's a piece of financial engineering in this industry that most buyers don't find out about until after the deal closes. The real financial engineering isn't the wash. It's what happens to the real estate underneath it. The predictable subscription revenue streams in this business have enabled what's called a sale-leaseback transaction, where the land under the wash gets sold off separately to a real estate investor the same week the operating deal closes, with the operating company becoming a long-term tenant on its own site. It reduces the deployed capital on paper and makes the returns look better for the buyer. But what it means for you, practically, is that the car wash you thought you were buying might come with a long-term lease obligation on the land that you don't own anymore. That's a fixed cost that doesn't go away when it rains for 3 weeks and nobody comes in. Now, there's one more layer to this, and this is the one I want you to actually sit with, because it's the thing almost nobody is talking about when they pitch car washes as a business opportunity. There seems to be a new car wash on every corner lately, but with the impact of drought, many Texas cities are doing what they can to conserve water. Cities are now banning new car washes near existing ones, not for competition reasons, but because of drought. McAllen became one of the cities in South Texas to impose a car wash ordinance that regulates the future growth of commercial locations, joining Brownsville and Edinburgh, which had already passed similar ordinances. Brownsville issued a city ordinance restricting new car washes from being built within 5 miles of each other. Edinburgh restricts new washes within a 2-mile radius. And Mission, Texas joined those cities with a 1-mile restriction, all citing worsening drought conditions, not competition policy. Think about what that actually means. The valley has been facing worsening drought conditions for years, and it depends on both the Falcon and Amistad reservoirs for its water supply. As of early 2026, Falcon was at 18.9% full and Amistad at 34.8% full. The Falcon reservoir hit historic record lows consistently over a 3-year stretch, dropping to 10% capacity in 2021, 9.7% in 2022, and just 8% in 2023. And although levels improved slightly, it wasn't enough to bring the supply to stable condition. In some of the fastest growing car wash markets in America, the government has effectively capped how many competitors can legally exist near you, purely on water supply grounds. If you already own a wash in one of those markets, that's actually a moat the government just handed you. Your competition can't legally open next door. But if you're trying to enter one of those markets, or if you're in a city that hasn't passed this kind of ordinance yet but is heading toward drought conditions, and a lot of cities are, you need to understand that your water access is not guaranteed. Corpus Christi, for example, declared Stage 3 water restrictions when the city's combined lake levels dropped below 20% capacity. And one city's ordinance requires all commercial conveyor car wash systems to install operational recirculating water systems within a year of passage or secure a waiver. A retrofit cost that has nothing to do with growth or competition and everything to do with a municipal mandate that can arrive with almost no warning. This is the thing that quietly breaks the valuation premise that made this industry so attractive to investors in the first place. Investors have been paying 18 to 20 times EBITDA for car wash businesses, largely because the industry has a reputation for being recession-resistant. The logic is, people always need to wash their cars. The subscription revenue is sticky, the margins are high. But that entire valuation premise assumes water access stays constant. The Texas ordinances prove it doesn't. So let's zoom out and look at what the smart money is actually doing right now, because it's changed. The most active acquirers in 2025 and 2026 are buying distressed singles, small chains, and entitled sites below replacement cost rather than paying for pipelines. The era of paying a massive premium for a growth story is over. What buyers want now is a mature, profitable single location or a small cluster of locations, already running, already membered up, already past the ramp-up period. And that brings up one of the genuinely interesting things about this business's math. A single car wash sells for 1 multiple. 10 of them in the same local footprint sell for a noticeably higher multiple, for no operational reason at all. If a single wash is worth 6 times earnings, 10 washes in the same local footprint are worth roughly 8 times to the same buyer. The underlying business didn't get better. The paperwork got more valuable purely because of how many units are bundled together. That's the roll-up premium. It's real, and it's the reason private equity got so excited about this space. The question is whether you're the person building toward that exit or the person paying the premium on the other end. There's also a wrinkle on the public market side of this that's worth understanding, because it's a genuinely rare insight into how growth math can work against you. Mr. Car Wash listed in June 2021 and briefly traded above $20. Then spent 3 years derating before Leonard Green took it private again at $7 per share, roughly a $3.1 billion valuation. The reason isn't that the individual locations were bad. It's that newly opened locations take years to mature, and continuously layering in immature units compresses blended margins, creating a perception problem for public investors even though individual mature locations perform well. It's a business whose actual unit economics are fine, but whose growth math is structurally incompatible with how public markets demand results be reported. Taking it private again was the rational move, because private ownership can accept temporary margin compression without quarterly scrutiny. If you're thinking about this as a comment worth leaving below, I'm genuinely curious. Would you rather own one great car wash and run it well, or build a portfolio of 5 to 10 and aim for a roll-up exit? Drop it in the comments, because the answer actually changes almost every decision you'd make in this business. And if you watched our video on owning a gym, a lot of this probably sounds familiar. Subscription math, private equity roll-ups, the gap between what a business looks like from the outside and what it actually is underneath. That one is worth watching back-to-back with this one if you haven't seen it yet. So here's where we land. You came into this video thinking a car wash was a machine that cleans cars and prints money. And in a narrow sense, that's not wrong. The unit economics on a mature, well-located express tunnel are genuinely strong. Very high throughput, very low labor. The subscription model creates recurring revenue that smooths out the bumpy weeks. The margins are real. But the business you're actually buying is more complicated than that. You're buying a subscription product with almost no switching costs, sitting on land you might not own, in a market that's increasingly regulated by drought conditions, financed by debt that can kill you if rates move the wrong way, and valued at multiples that assume water access is permanent. The machine works. Everything around the machine is where the risk lives. The operators who are going to do well in this next phase are the ones who buy right, meaning below replacement cost in markets where they've actually checked the water situation with conservative debt and a clear answer to the question of who they're eventually selling to and why that buyer will pay more than they did. That's the actual business, not the line of cars on a Saturday, not the RFID tag reading a membership sticker. The water table, the debt structure, the exit multiple, and whether the city you're in has already decided how many of you are allowed to exist. Now go watch the gym video if you haven't. The parallels are going to make a lot more sense. And if you found this useful, subscribe. We do this for a new industry every week, and the next one has a business model that's even weirder than this one.